So, welcome everybody to the Capital Discussion Market Analysis. I'm Tom Nunemaker with Jim Riggio. Before we get started, we have our disclaimer that's at the bottom of all our web pages that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And I always have to think of Charles Cottle when I do this. Did you ever see the video he did where he just fast-forwarded a recording of him reading a disclaimer? It sounded like, one of Alvin the Chipmunks reading it.
No, I did not.
Well, I'll have to do that sometime. It's pretty funny. So
Yeah,
anyway,
let
me change the ball to you, Jim.
Okay, and let me share. One of the things that people might end up knowing when we end up talking during the trading group, one of the things that I was a bit afraid of was that the leadership seemed to be getting narrower. That some of the individual companies, because of the strength of the dollar, and it really is not so much the strength of the dollar as much as its weakness of everybody else, especially the Japanese yen, that the leadership was getting narrower and narrower. And that is a very late stage. If there was probably the most important lesson that I learned during the dot-com bust was that when you went back and you took a look at how leadership got to be fewer and fewer companies, but they were the largest cap companies, so you didn't see the indexes come down. But the leadership definitely got, meaning the up companies, okay, that were driving the market higher, were getting narrower and narrower. It was a pretty clear sign. The same thing when there's, a particular company or segment or industry that ends up driving things down. Today, the story is oil. Okay, if you take a look at this, one of the charts that I leave up all the time, that I take a look at is this, right? Tom, you can end up seeing my market watch list?
I can, yep.
Okay, and all this is just the different sectors. I want to see the different sectors, and I'm not interested in saying, ooh, if I check out this biotech or this biotech versus that biotech ETF or, some portion of the energy. I'm just looking broad strokes here. Where is the leadership coming from? And you can end up seeing that energy, okay, by far drove everything down. The other thing that I end up doing is that I take all of these select spiders, the spider selects. You can do it with, whatever you prefer to end up seeing, but with an industry group. And what I also do then is I chart them. By the way, you need the starting point, right? So I'm always looking for what's driving everything lower or higher. And it's pretty clear if I come over here, this is the guy who's causing all the problems, and lo and behold, it's XLE, right? So I know, and I have my colors written down. So I'll know that, the aqua one is XLE, the yellow one is consumer staples, okay? So you have to end up knowing your charts however you want to end up setting them up. But take a look at this. Now, normally, my first thought used to always end up being, well, if oil is being driven down or the energy sector is losing money because oil, okay, is getting so cheap, isn't that good for all of the other industries? Doesn't that drive all of the other industries higher? And the answer is, to a degree, yes, if it's for the right reasons. I think that the extra supply between fracking and, the central, or I guess the Midwest or North Midwest oil, okay, that's come on, from the Dakotas has been a big, boom to the oil production, and that's driven the supply up, and the demand has not ended up increasing, and so hence the market's oil prices have come down. This, to me, is, the biggest thing that ended up causing. Let me detach this, put this on the side, because I'm going to end up coming back to it in a second. Sorry, wrong place. Detach. Okay. What I wanted to end up showing you is, let's just get a basic graph here, and I want to end up showing you what's happened, okay, to oil. I mean, because to me, that's where the story has really been driving things. Let's just take a look at a basic chart. How far out have we gone? Let's go out to, let's look at a weekly chart so we can, or even a weekly, so we can see a lot more stuff on it. Let me get oil up on the chart. This goes back to the beginning of '95. The last time we had a huge drop in oil like this over several weeks was during this phase. Now, look at what happened here. Early July in 2008, long before the September market crash, oil came down. There was a difference. Okay, this huge drop-off in oil after a huge run-up was caused, right, because we had a run-up over a year period, let's call it. It was run up because of speculative buying in oil, and then two, a dramatic curtailment of the demand. So I don't think that we're in the same type of situation, but it's hard not to end up taking a look and seeing what has caused this. I mean, take a look at here, take a look at what we ended up having a run up from early 2007 all the way up to mid-2008. We haven't had that type of run up, okay, that has caused it. But it is something to be noticed. If afterwards, if the market does end up having a major correction, you'll end up hearing people talk about this. But because of oil's dramatic sell-off, and especially, okay, over the last couple of days, you can end up seeing that today, going back to what was driving everything down, the answer was, by far, by far, it was the energy companies. The second one, by the way, were the basic materials. Okay, so, part of that is, other basic, things that we end up mining or drilling for. So that's basically, what caused a big chunk of the issue. The other thing that I wanted to kind of end up going over today and end up showing you real quick was this is the chart that I end up always keeping up on on my, let's call it my TV monitor, which is above everything. Let me move this over to the side.
Oh, while it's loading, Jerry had a comment. I seem to remember the CME margin requirements popped that bubble in CL off in a heads up.
Yeah, to a degree. It's a, margin issues. When the CME ends up doing that, there's always, you have to realize that's a pretty big political thing, because if you're on the margin committee, if you're a trader on the floor, you're going to get yourself massively short before you start lobbying for that, right? I mean, I know a guy who's, multimillionaire, because he was on the margin committee for silver back in the 80s, and when the Hunt brothers were buying just tons of futures and stuff, they lobbied very hard and they changed the margin requirements. And lo and behold, the Hunt brothers had to dump their silver. And who was short all of those contracts? The CME traders who were on the floor, who were part of the margin committee. Shocking, I know. Anyway, what I wanted to end up showing here is that one of the things that ended up happening was, the yen midday had a reversal, and so did the euro. So what ended up happening, in terms of the U.S. dollar, we started to end up getting a little bit weaker in the dollar, but then it stopped, okay, midday. And that ended up causing an issue, and that's what you ended up seeing here. This was the reversal and these are the E-minis up here. We were selling off, selling off, selling off. Okay, so we were basically mirroring, everything seems to be driven by the price of oil. The oil is traded in dollars. It's moving against different currencies. And right now, I think a lot of this ends up being you're seeing a lot of influence from the quantitative easing that's going on around the world. When you take a look at what's going on with the price of oil, because of the strength of the dollar and everything else that I'd mentioned, you know, it's not going to end up really getting any headlines in the news because it's quote unquote good for Main Street but not good for Wall Street, right? It's good for Main Street. Everybody's happy that gasoline prices are going down. Tom, Europeans are excluded because you guys pay 90% of what you pay is tax. But since oil prices are going down, gasoline prices are going down, Main Street loves it. Not so sure about Wall Street. It's going to end up creating a little bit more volatility. Now, having said all of that, if you take a look I want you to take a look at the 6 lower left ones here, and I don't know if I can end up doing just the 6 lower left, so let me just do it this way. So it's a little bit easier to see. Okay. I want you to end up seeing the way what you're looking at here is the E-minis, right? The S&P 500 futures, the S&P 500 volatility index, or the VIX. Next one is the NASDAQ futures and the NASDAQ volatility index, which is the VIXIN. The Russell futures, and then right below that is the Russell VIX, if you will, or the RVX. Below this are 3 other things that I end up tracking. It's the VVIX, the volatility index on the VIX options. So it's basically the volatility of the volatility, right? Multiple derivatives, I know we're talking about. And then I take a look at the most liquid ETF that tries to emulate the VIX, which is the VXX, and then the 2X levered one of that, the UVXY. They moved up, and they moved up hard throughout the day. It was kind of hard to end up, watching these things going up. If I go back to just taking a look at let's say a 5-minute chart of the VIX, and let me just pull up. Let's take a look of just the VIX futures. So let's get the whole day on here so you can see the whole day. We moved up pretty dramatically. I thought we were going to start to sell off going into this, and we didn't. I would be somewhat concerned about it. If I end up showing, and I've showed this chart several times, but if I take a look at the different VIX futures, and remember what this one is. The bottom one is the VIX cash, and then as you go up, it's the first month, the second month, the third month, the fourth month. We are still massively in contango, Our contango percentages haven't really changed very much. Our VIX changed dramatically. For those of you who don't end up liking to look at it this way, I know I've showed you the easy website, to end up going, if you don't want to end up building your own charts and looking at looking at it real time, and you don't mind looking at delayed quotes, VIX Central does a pretty good job. We're still 10%. You see this number down here? 10% in contango between the first 2 months. It's hard to end up worrying about volatility popping when you have a contango that big. That's massive. Guys that don't end up watching this, for the entire year, other than a few weeks in, let's call it early February, a week or so in July, and a week or so just recently in October, or early November, when we ended up having that drawdown, we've been running in the 4 to 7% range. That's kind of our normal range. We did get in backwardation a little bit during those 3 times that I ended up mentioning, but 10%, I mean, I had to go and search the database to find out how often we've been in 10%. Now, we've been in greater than 10%, okay, during times, but not when volatility is this low. It's hard to end up having, okay, a VIX of 14 and being 10% in contango. Usually when you're 10% in contango, it's because, we're going from 50 down to 40 or from, 55 down to 30 in the VIX, and that's when you end up getting those massive numbers in contango or even in backwardation. Here, this is one of the biggest Christmas time drags that I've seen since the VIX futures have been trading. So, it's hard for me to end up getting worked up on is this real or not? Should I be concerned? The other thing I just wanted to end up showing you when I take a look at this whole thing is what the volume's been looking like. Okay. Top one is the volume for the New York Stock Exchange listed stocks, and the bottom one is for the NASDAQ listed stocks. You can end up seeing that, volume's been higher, but volume hasn't been massively higher. With a sell-off, okay, this big compared to how flat we've been, I would have expected the selling to end up, really picking up, but it is marginally higher. It's not like it was massively higher. Yes, it's a distribution day, so those people who like to watch, the IBD specific rules of accumulation versus distribution. We'd had a significant downdraft on higher volume than the day before. All true, and yes, it is a negative. I'm not saying it isn't, but contango should have budged a little bit more. Volume of this amount of selling, probably if it was truly massive distribution, would have picked up a little bit more. So I'm just waiting. I think that tomorrow, the rest of the week, we can, if we end up stabilizing it all, volatility ends up getting crushed on some of those things that I showed you, the VVIX or the tradable products like the VIX futures, the VXX or the UVXY. And so that's what we've been looking at. Trades that I put on today are things that I had done. Tom, on the butterflies that I had, not the double Dan Harvey one, but that I kind of do a version of the Kevlar. Let me see if I don't have the actual trade that I put on. Do I have it? No, I can't. But I can show you what I did before and after.
Okay. Dave Stewart mentioned that percentage contango was about 12.9 on Friday, so it didn't drop that much.
Right. With this, right, Dave, with this level of a drop, okay, first of all, 12 was extraordinarily high. As it went above 10, I was like, that's when when we got up to 10, we started searching the database to see, hey, had this happened before? And so for us to end up going and still being at close to 10 after this level of sell-off, it's almost like the market, yawned at the sell-off. Okay, it wasn't anything that was large. Okay, and let me come over to here. Okay. What we did today, and let me just show you this. We just do this way, and go down to 2000. Oh, wrong one. Okay. So I adjusted things because whenever I adjust things, what I always do is I always reset my counter to 0. It's if I've taken profits off of a trade, It's not like I don't like to end up counting them. So, well, I can risk my profit. No, 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 no. They're already in the bank. They're cashed. My investors have spent them. I got to start all over again. This was the trade that we ended up having on. Basically, you can end up seeing what this was a Kevlar fly for a while that I had sold off, and the lower left leg, left of the butterfly, was slightly lower than where the right leg was. And what I've done is I've just continually sold off, okay, some of the long, okay, right side wings that I've had. And I did that again today. What I did was today, though, instead of making it an even butterfly, you can end up seeing it was the original butterfly was a 25 points, and what I had done is that I had rolled out some of my wings. And so basically what I did was that I ended up, can I end up showing it to you here? Hang on a second. Let's see if I can't get, yeah. Okay. Okay, so here were, let me put it up here so it's easier to see. There were the trade logs, what was done today. And so you can see what I did was that I basically bought the 2,000, sold the 2,000 and 25s. I had done that 15 times. So these were the 15 that I rolled. So I took 15 off of the 2,000s and I rolled them out to 25. So instead of the chart looking like this, okay, the chart now looked like that. I rolled basically from here up, collected some money, gave myself more room to end up making. If we pull back, I don't have to worry about below 2,000. This is an end-of-year trade, so I'm not ultra concerned that we're going to end up pulling back another 60 SPX points between now and the end of the year. So it was a way for me just to end up trying to collect a few extra dollars. One of the things on this trade that we end up liking, and now remember, this is the same concept, okay, in most of John Locke's trades and most in Dan Harvey's trades, is that when you have a structure that looks like this, every single day the white line's going to get closer to the red line. And so what I wanted to end up showing you is that if I break this thing down by day, let me get down, oh, there we go, there, right? So each one of those lines is 6 days. So you see, as we go down, as we get closer to expiration, now this is not changing any of the volatility. If the volatility actually ends up coming out of today, each one of the red, orange, yellow, well, green's expiration, they get closer to the green line, which is expiration. What's the date on each of those lines? It's here on the left-hand side. Let me make the graph a little bit bigger so it's easier to see. Okay, so you can see here that I have some, what I think is some pretty reasonable theta. If we end up pulling back, I end up having some extra protection on the downside. Do I need to end up taking action if we start to end up pulling back? Yeah, I do, but not overly. Okay, I don't have to take any type of excessive action. You can end up seeing what I ended up actually doing today was that I was relatively flat. So when we came down, even though I lost a few dollars, okay, as we ended up pulling back a little bit, what I did was that I bought a below the money call spread, because they're all calls, which is the same thing as selling a below the money put spread, right? It's the exact same trade. But what I did was, by doing that, by moving some of my shorts from here up to here, I was able to end up collecting, as I showed you, I was able to end up collecting about $4.80 on a $25 spread. Why do I view it as collecting $4.80 and not paying $20.20? Because I paid $20.20 for a $25 call spread. Had I sold the put spread, right, buying at $20 buying a $25 call spread and paying $20.20 is exactly the same as selling a $25 put spread and collecting $4.80 for it. So that's the way I ended up viewing it, and that was the trade that we ended up putting on, okay, for this today.
Jim, is there any reason that you wouldn't just do the put spread, knowing it would just go out worthless at the end?
Yes, because I'm already getting in. Let me show you. Okay, let me show you something else here. Because I already have these calls on. Okay, because I already had the calls on, I'm just adjusting the position that I ended up having. I used the puts to price what I would have to end up paying for it, right? I don't use the calls to do the pricing. Very, very important. Because when I take a look, right, when you take a look at the 2000s, right, and I'm here on the quarterlies, look at how wide that spread is. That spread is $2.10 wide. The corresponding put spread is only 40 cents wide. There's a lot more potential error in the pricing over here. So I don't even look at what that mid is on the call. The only thing you can end up doing is messing up if you look at how expensive that call spread was. Use the put spread to do the pricing. Whatever the puts are, whatever you can get for the puts, just minus it from $25, and that's what you're going to end up paying for the call spread on the for the call vertical spread.
And do you find those deep in the money calls have relatively good execution? You know, you're able to get filled at a good price?
In the SPX, yeah, because the thing is that, you know, every quant in the world is on there, and if they can end up getting, you know, they're not going to they're not going to end up letting it to get too wide because they know somebody else is going to step in front of them.
Right.
You know, so, you know, maybe I'm giving up a nickel, but you have to walk it up, right? So I put in the price of where I think I could end up going, or, you know, let's call it 25 or 50 cents better than where I think it can go, and then I start walking it up a nickel at a time. You know, so when I got executed at $22 and $20.20, I started it at 1970. Then went to 1975, then went to 1980, and I just walked it up, and I let it sit there for a couple. As I got closer to the mid, you know, I'd let them sit there for a couple of minutes. Okay, you can't end up doing this, obviously, if you have to get executed. You're going to have to end up paying up for it. But I was just trying to end up doing a roll. And think about what I was doing. I was basically selling a put spread below the money, okay, in today's market. I should have waited longer. I would have gotten more money had I sold it later in the day. I got executed a little bit before lunch. I guess I would have gotten my most money probably, you know, right after lunch.
Very good.
Tom, any questions that we have? I don't see. I have to go over.
I didn't see any. Do we have any economic news coming out? I don't remember seeing any.
Nothing really big coming up that I'm too worried about. Let me come over here and just show you. Nope.
Oh, you were on it.
I was on it. You know, jobless claims. We had a great employment report. Oh, you know, I'll make a comment about the employment. The employment report was so good on Friday that there was a little bit of, you know, it was almost like mixed news. It was so good that some people were afraid that interest rates might move up higher. Okay, so that ended up causing a little bit of a you know, issues in the market where we sold off initially and then we ran up, and then so we moved around. We increased the volatility around somewhat, but nothing that I would end up saying, oh, you know, this is a concern because of.
Right.
Okay.
And then as far as, we're still in pretty good contango, like you said. What are you looking at for the market short term, next couple days?
I think that the spike in volatility that we had probably ends up coming out, you know, for the volatility to stay up here, for the VIX to end up staying this high, or for the VXX, or the tradable products, to stay up this high, the contango is going to have to become lessened. It's going to have to become much, much smaller, which means that when you're this steep, okay, the only way I see contango coming out of this thing is that we're going to have, uglier news, a bigger drop, and the front month VIX is going to have to end up going up. Okay. The back month, okay, the Januaries, they're stubbornly holding on to their higher implied volatility. So that, 9.5%, 10% contango that we've been seeing is just a huge drag on any of those VIXY or VXX type products. So, okay. Guys, any other questions?
I don't think so. Dave Stewart said Santa Claus is releasing his Dees minutes on the 25th. That's nice of him.
Dave, let me take the suspense out of it for you. I've been naughty.
Oh. All right. Well, I think that's pretty much it. There's no more questions. So, Jim, thanks very much for your analysis and views of the market.
Guys, thanks a lot. And what do we have the rest of this week going on?
Well, we've got our trading groups on Wednesday, and I think we're still trying to fill Thursday. We had our speaker kind of drop out, so we're trying to figure out who can speak on Thursday. So we'll stand by to for that.
The person that you asked for, did you get a response?
Yeah, but we need to talk on the phone. So
okay.
I don't think that one's going to work. So let's try the live all guys if you can.
Okay. So guys, let me ask you real informal, question right now. One of the things that we were thinking about doing was, and let me pull this up on the screen. I'm not very good at this because I don't end up trading this, but I know a lot of people do. This is the Pro Scanner from Livevol. They have a ton of pre-canned scans, okay, on things like, volatility, earnings type plays, time spreads, order flow stuff. It's just amazing how many pre-canned type of scans that they have that, some of the traders, most of the brokers at Livevol used to end up being floor traders. So these were the types of things they would end up doing. Tom and I were thinking we had an offer from Livevol to actually come in and walk through a couple of the scans that they end up doing. What do you think? Would you be interested in that? If you just write in your comments here, okay, in the chat, or if you're listening to this, okay, after you've downloaded, maybe just drop Tom an email on it, and if it's something that you guys think would make a lot of sense, we can definitely get somebody, one of the former floor traders at Livevol to walk us through what they end up doing. So that's what we were thinking about Thursday.
Yeah, no, I'd like to see it. I'm always interested in interesting tools. Yeah, it looks like we're getting good response. So yeah, why don't you see if you can get your contact at Livevol to come do a demo.
I will. I'll make those calls right now, Tom. Anyway, have a good week, guys, and we'll speak to you on Wednesday and Thursday.
All right. Thanks a lot.